Now, I know that your nonprofit mission means the world to you, and it would suck to lose your nonprofit's tax exempt status because of an avoidable mistake. That's why in this Changemaker Cafe episode, we're going to talk through 6 major ways you might put your nonprofit tax status at risk according to the IRS. I'll share what each means, an example of what a risky action might look like in the real world, and a few tips on how to avoid these risks altogether. As always, don't forget to subscribe to the channel for more content on nonprofits, fundraising, and more. Let's get curious. Let's jump into a big one first, and that is private benefit and inurement. So here's what that means. Basically, 501c3 nonprofits, in order to have that tax exempt status, must operate to benefit the public, not just a single person, a single family, business, or a small group of people. So private benefit and inurement are forms of what's called conflicts of interest. In general, they relate to doing things like excessive compensation of nonprofit leaders, forming financial or vendor relationships that benefit only one or a handful of groups, or personal use of a nonprofit's assets, etc. Private benefit is defined as when a nonprofit's activities substantially benefit a private individual or entity. But I want to be clear about something because this confuses a lot of people. This is completely unrelated to hiring an individual to be a paid staff member for a nonprofit. Hiring people to work for a nonprofit and paying them a fair and competitive wage is totally okay and not an example of private benefit or inurement. Some people don't even realize that nonprofits can and often have paid staff at all, so I always like to reiterate this as much as possible. Paid nonprofit employees make up about 10% of the entire United States adult workforce. It's the third largest sector. So having paid staff at a nonprofit is extremely common. What private benefit is talking about is different. It's saying that your nonprofit's programs or operations provide unfair or inappropriate benefits to a single person or entity. So what do I mean by that? Let's take a look at something in real life. Let's say a nonprofit needs some t-shirts and the nonprofit's board chair just happens to have a side hustle as a for-profit t-shirt maker. If the nonprofit automatically chooses the board chair's t-shirt company as its vendor without vetting any other options and or pays them above market rates for those t-shirts, then that board member is unfairly benefiting from their connection to the nonprofit. Now, inurement, that's such a hard word to say, is when insiders like board members or executives personally profit financially from the nonprofit's earnings or assets. Unlike private businesses, nonprofits do not distribute profits or shares to their leadership. All the money must be reinvested back into the nonprofit's operations. So an example of inurement might be if the nonprofit owns a vehicle for its program operations, but the nonprofit's executive director uses that vehicle for their personal and private use without reimbursing the organization. To avoid engaging in these types of behaviors, even by accident, here are a few steps that you can take. The first is to always document the fair market value of a service or item when contracting with insiders. The second is to have a written conflict of interest policy that requires annual disclosures of any conflicts. And the third is to make sure your board and staff review and understand these policies so that they know what behaviors are prohibited, because it's not always obvious. Okay, let's talk about a second way to lose your nonprofit status. You might think it's not a big deal if your nonprofit starts doing things outside of the scope of its original mission statement, but you'd be wrong. The IRS considers straying from your stated mission, which is that mission statement that you provided to the IRS when you first filed for 501c3 status, to be potentially an exemption losing offense. Let's say, for example, that your nonprofit was originally started to provide services to the homeless, and then a few years pass and you decide you want to pivot your activities and mission to be tackling the mental health crisis, and you fail to report this to the IRS. Now, to clarify, there's nothing wrong with pivoting your mission in general. Lots of nonprofits have done this, and you can argue it's even maybe a good practice to adjust your efforts as you learn more about the needs or specific challenges in your issue area. One famous historical example of this is the March of Dimes that I bet you've heard of. Starting in the 1930s, March of Dimes had a specific mission to help discover a vaccine for polio. But after the polio vaccine had been developed, March of Dimes faced a choice. Should they close up shop, mission accomplished, or use its infrastructure to tackle a new problem? You might know that it chose the latter. Today, March of Dimes' broader mission is to improve health for mothers and babies. So, reiterating that the problem isn't with changing your mission, it's about failing to report your changed mission to the IRS in a timely manner. Here's what you need to do if you do need to change your mission to avoid these IRS challenges. You need to make sure, for example, that you have a formal written record of the mission statement change. It should be documented in your board of directors meeting minutes, noting the votes to approve the change, and then updated on any documentation like your bylaws. Second, you need to submit your updated mission statement on your annual tax forms to the IRS. And third, as a good practice, each year review your mission statement with your board of directors and make sure that your activities and programs stay closely aligned with that purpose. The third activity that can put your nonprofit at risk of losing its tax exempt status is having too much of what's called unrelated business income, or UBI for short. So if you're not familiar with this term, unrelated business income is basically money earned from ongoing business activities that are not related to your nonprofit's mission. This one I know confuses a lot of people too. So let's talk about a real life example. Let's say you are a youth arts nonprofit, but you run a coffee shop business that has no art programming, no educational tie into your mission, or any other direct connection to your programming. And let's say that coffee shop brings in more revenue to your nonprofit than you receive in other types of funding like donations or grants. Well, the money that your arts nonprofit earns from that coffee shop would be unrelated business income because its income is totally unrelated to the main business, aka the mission of your nonprofit. So here's how you make sure that you stay in compliance with this. First, you need to make sure that your revenue generating activities actually do align with and directly connect to your mission. It's totally okay, it's even common to charge fees for your nonprofit's programs or services. That would be generating revenue in a way that is aligned to your mission and not count as unrelated. And you can still generate some income from unrelated business income. It just can't be a large amount of your nonprofit's funding. If your organization makes over $1,000 a year from UBI, you need to notify the IRS by filing Form 990T. Be sure to look up all of the nuances related to unrelated business income on the IRS website. Now, whether or not your nonprofit engages in any unrelated business income activities, chances are you do still need to do a bit of fundraising to support your mission. That means you'll need a reliable fundraising platform to help your organization collect donations and grow your revenue, which means it's a great time to share more about the sponsor of this video, Click and Pledge. So with Click and Pledge, you're going to get a robust dashboard where you can plan your fundraising campaigns, monitor your progress. You're going to get highly customizable donation forms, in-person fundraising features for when you're out at events, text to give, peer-to-peer fundraising that allows supporters to form teams and raise money from their networks, video fundraising with donation links embedded directly in your videos, donor outreach tools to improve retention, a complete Salesforce integration, many other integrations, and more. Some platforms charge more based on your organization's size. That's just a fact. But Click and Pledge doesn't do that. Their pricing is going to stay the same even as your donor list size increases. Nonprofits really appreciate how there are no contracts and all of their solutions are included at no extra cost. I encourage you to go learn more about Click and Pledge's fundraising solutions. And if you do and you scan this QR code, you can get your first $25 monthly fee waived using that code or the links below this video. Get in contact with their team, schedule a demo, ask questions, or sign up to give it a try right now and let me know what you thought. The fourth activity nonprofits have to avoid to protect their tax exempt status is political campaign activity. Basically, what happened is in 1954, Congress approved an amendment to the tax law that strictly prohibits 501c3 public charities from endorsing or opposing any specific candidate for public office. So, for example, let's say your nonprofit's leadership uses the organization's newsletter or social media page to endorse a candidate for the mayor of your city. Or let's say your nonprofit allows campaign signs for a candidate at one of your events. These types of activities would be no-nos. Now, one thing I want to point out that this is different from encouraging general civic engagement, dialogue, and participation. Like, for example, your nonprofit can totally host events that give an equal platform to all candidates running for office, like, say, a community panel where you invite all of the candidates to weigh in on an affordable housing issue. The issue is that your nonprofit can't show bias or attempt to use its social capital to influence political campaign results. So to stay in compliance here, simply don't post or share political content on your organization's official channels. And then train your staff and board on what is and isn't allowed. Personal opinions must be separate from the organization's on candidates and campaigns. Now, in a similar vein, excessive lobbying by nonprofits is considered a fifth behavior that could put your exempt status at risk. Lobbying, of course, is trying to influence legislation by contacting lawmakers or encouraging the public to do so. But the key word here is excessive. Some is allowed, and advocacy is common in nonprofits, but it can't be a substantial part of your nonprofit's work. In the real world, an example might be an environmental nonprofit spending half of its staff time and resources advocating for a new law banning pesticides. And this is all for 501c3 public charities, by the way. So to stay in compliance, be sure to try to accurately calculate the portion of your nonprofit's time spent lobbying. And the challenge with this rule is that the IRS says you can't do a substantial amount of lobbying, but it doesn't say exactly what substantial means. So you might consider filing IRS Form 5768, which basically helps you calculate your time and if you're over it. Then track that lobbying time and other expenses separately. Sixth and finally, and this is a big one, failing to file annual reports to the IRS could lead to removal of your tax-exempt status, perhaps even automatic removal. Here's the deal. 501c3s must file an annual IRS Form 990, 990EZ, or 990N. It's like how you have to file your taxes every year as a person. Nonprofits have to do this too, even if they're tax exempt. And if you miss filing the paperwork for 3 consecutive years, your nonprofit status will be automatically revoked, and the IRS does not mess around with this. In June 2011, they even publicly shared a list of almost 275,000 organizations that lost their status for failing to meet their annual filing obligations for 3 consecutive taxable years. And who knows, they could do that again. You never know. In real life, what might happen is something like a small nonprofit thinks it's too small or has too little revenue to file. Then 3 years later, its tax-exempt status is just gone and donations are no longer tax deductible. And I've personally seen this. I was advising someone who had started a nonprofit several years ago, but couldn't find a record of their active nonprofit status online. And when I discussed it with them, we discovered that the IRS had revoked their status due to failure to file. And now they have to pay a refiling fee and wait, and it's this whole thing. So to avoid this, you want to set a recurring calendar reminder every year for your filing deadline and work with an accountant if possible. And also throughout the year, use accounting software or someone who can help you to ensure compliance. In my experience, once you set up some simple systems and software like QuickBooks or other accounting alternatives, it's not too hard to stay on top of it with reconciling your nonprofit's finances each month so that you can file those tax forms each year. I truly hope that this helps you stay aware and on top of these things, and let me know what questions or thoughts you have in the comments below this video. Don't forget, you can always get more content in my weekly newsletter and resources on my website, changemakercafe.com. And be sure to subscribe to this channel and turn on the alerts for the channel so that you don't miss our next episode. I'm Amber Melanie Smith, and I'll see you later. Bye.